Welcome to Chapter 31. I'm Mr. Rodman, and we're going to take you through monetary policy. Now, this is not meant to replace your reading Chapter 31 in the Krugman text, but the idea here is to supplement those efforts. So this would normally be stuff we would go over in class, and obviously not having the opportunity to do that right now, this is a close second, we hope, to at least trying to fill that gap. What are we going to take a look at in this chapter, looking at monetary policy? This is going to lead us into the next unit, looking at chapters 32 and 33, but the idea here of the money demand curve, of this idea of a liquidity preference model. Why is it that sometimes we want to have more cash, sometimes we don't? And then how does the Fed move interest rates? How do they make that happen using this monetary policy? This idea of bird bonds and interest rates. How do they make that happen as a result of an open market operation? And then what's the importance here of monetary neutrality? This idea of, in the long run, monetary policy really not having a whole lot of an impact, and how does that take shape? Which is what we're going to take a look at near the end of this chapter. So let's start off by looking at this idea of a liquidity preference model, the quantity of money that we have. And this is in relationship to the interest rate. As interest rates are higher, we're going to want to keep less money in cash and put more of that money into investments where we can actually get a greater return. I mean, think of it like if I keep money in the bank, my checking account's going to give me 1%, versus if I invest it in other types of funds, CDs, and so on, I may get 3 or 4%. And if I invest it in the stock market, I may get 8-10%. I don't know. But the idea is there's less of an incentive to keep it in cash. That's the idea of the liquidity preference model. Now, as interest rate falls, the opportunity cost of holding on to cash isn't as great. And so people will want to hold on to more of that money. So the demand for money in terms of that nominal quantity will be greater as a result of that lower rate. It won't be as much incentive to buy those other assets. Usually we see that in times of recession. People are less inclined to put money into other things. They go back for the safety of cash. And that's what we see in a lot of cases. Now, when we have a rise in aggregate price level, the idea is the interest rate is going to change, the demand for money also shifting, and this leads to a shift in the actual curve. We'll talk for a second about what's going to shift that curve, but the idea here is the money demand curve, the entire thing moves either to the left or to the right. If you see a drop in interest rates, but people also don't want to hang on to cash, you may see this curve shift to the left, where interest rates are lower, but the demand for money is also lower because people are putting they're good times. People are putting it into other assets. So that could be the case. But primarily, the relationship that we see here is in the short run. The idea that as interest rates fall, the demand or the quantity of money that we hold liquid or in cash would be greater than if the interest rate were higher. You could get money out of other assets as a result. So the idea here is that the real money demand curve is going to be that relationship between the money that is demanded and the interest rate. And this is the real quantity of money. So we're looking at it here in terms of the real demand for cash. Also, in those terms, the idea here is if the prices rise due to inflation, just because the price level is rising doesn't always mean that the money demand curve is going to shift. You would have to look at it in terms of the interest rate and what would happen there, in terms of if the interest rate is changing at a pace that the quantity of money being demanded is also changing. So you will want to take a look at that in terms of really 3 factors that would shift this real money demand curve. And that is changes in aggregate spending, changes in technology, and changes in institutions. So let's look at each one of those for a second. If we go back to the graph and we look at changes in real aggregate spending, if more people are spending money and that is what is driving up the cost of goods, leading to a higher interest rate in other assets, they may be using more of that money and may need more money in order to buy those things. That could shift the curve outward or inward, depending on which is happening. Likewise, if people are spending less, like right now during this coronavirus recession, we've got the situation where people the interest rate isn't greater, it's actually lower, but people are also concerned about they're not going out and spending money, so there's not a whole lot of spending there in terms of I need more cash. So you got to look at it in terms of what is happening. But if there is a relationship in which the interest rate is changing at the same time as the real quantity of money and the demand for that money is changing, that could lead to a shift in the curve. Now, the other item we mentioned was technology, the idea of changes in technology. We have seen changes in technology over time that have led us to get more money in return on our assets that we don't necessarily need cash for. We have Apple Pay, we have e-wallet, we have lots of other assets, Square, where you can run your credit card and they'll send you a receipt. Lots of small businesses use that. So that technology has changed and led to us not needing as much money on hand because we can spend it without having to actually use cash in our possession. And then the last one is changes in institutions, and that's more the regulatory or the legality aspect, such as changes in regulations that require banks to hold on to more cash, reserve requirements, or changes that require businesses to have certain amount of assets and certain amount of regulatory requirements that they need cash on hand in order to meet. Those types of things changing or being relegated to the annals of history would lead to changes in this money demand curve. You don't need as much of it. Great, that's great. So that would lead to us putting money in other assets and other places that would be more valuable as a result. So any of those could shift the real money demand curve because the idea is it's not having a significant impact on interest rates itself. It's actually shifting the curve, which is impacting interest rates at the same time. And that really is the difference. Now here, Krugman talks about the velocity of money really as this idea of what we call MVPQ. You'll see it a lot of times as the velocity of money and your velocity of money in terms of how it turns over. I go in and spend money at Giant. That $5 that I gave them at the register is then used for somebody else to pay a customer in terms of return change that they go use at the dry cleaners. And then they use that money to give to somebody else who then buys a sandwich at Subway. And then somebody at Subway uses it over at Starbucks to buy a latte. So the velocity of money in terms of how much is that dollar changing and turning over, that it's being used in the money cycle, because that can lead to a greater aggregate spending. The idea there is if you have more people spending money in the marketplace and that real demand for money is increasing because the velocity is increasing, then what you're going to see is price and real GDP, price and quantity, price and real GDP, as you see here, P and Y, that is going up, because the idea is it's an equation. So if you have the velocity of money and real quantity of money on one side, M and V, and then you have price and quantity, or price and real GDP on the other side, if one is going up, such as prices, inflation, then the demand for the quantity of money, the M, is going to go up. If the real GDP is rising and it's not prices, then the velocity of money is going to be rising. So either way, they're going to be equal because it's an equation. So think of it that way in terms of that velocity that's attached to money. How much money do we need? How often can we turn over that cash in the marketplace? That ties right into real GDP. If more people are spending, that's going to lead to greater real GDP. That's not necessarily inflation that's caused by those prices. And that's really the difference that we see here. And you can see it in a number of ways. This is just another way to take a look at it, but the idea is the same. If you look at the quantity of money that's demanded times the velocity, and that should be equal to your real GDP times price, or your price times real GDP, or Y is what you see here. Okay. Now, there is an activity 4-8 that I had you take in class before we left. So if you haven't done that already, please do that. You'll find the answers on Google Classroom, and you can check your work in terms of making that happen. I think you'll find that helpful. Looking at money and interest rates then, as we take this liquidity preference model and looking at how this has an impact on rates, it's important to note, Krugman talks about this in terms of the supply and demand for money. Interest rate is really a result of that. If more people are demanding money and there's less of it, that's going to drive up rates. If there's more money out there and more people are spending and the demand for product is different, that could lead to higher interest rates in terms of inflation, in terms of what people are willing to pay. So it is a result of the supply and demand for money in terms of what is needed in order to pay bills, in order to pay for goods and services that we use. And so the money supply curve that we see here is going to be indicative of that. What we see here is the demand for money is this downward sloping curve, much like the demand in general, but the money supply curve is going to be a vertical line. It's going to be what the Fed institutes in terms of the money supply, and that is a vertical line always. The money supply is a vertical line. So that takes us to key graph 24 then, which is essentially this money market graph. And you can pause it here to copy this down and then continue, and I'll talk about it. But the money demand curve is downward sloping, as we said. The liquidity preference model tells us this because of its relationship in interest rates and the demand for money, the supply and demand for money. The money supply is determined by the Fed. So the equilibrium that we see here in terms of the nominal interest rate, inflation is built into that, determines what our quantity of money is. So if the money supply is increased, the Fed is buying bonds, for instance, that would lead to a greater money demand at a lower interest rate. And we know with lower interest rates, more people will not see any advantage in putting money into other assets. They'd rather have money in cash. And so they'd keep it here. The demand for money would be greater. Conversely, if the Fed sells bonds in order to decrease the money supply, moves it over to the left or inward, that would lead to a higher interest rate. And as a result of that, the demand for money is going to be smaller because of the fact that people can put that money into other assets. They can put it into other assets and get a greater rate of return on it as a result. So that's essentially what we see in this money market graph. And we'll use this in quite a few graphs here in this chapter, but that's essentially the model. Now, if we take a look at what I was talking about, this idea of buying bonds, increasing the money supply, you can see here the equilibrium is falling, is moving along the money demand curve and falling at a lower rate, but the demand for money is greater. Why? Because the interest rate's lower here. There's no incentive to put your money into other assets that are going to yield greater returns, so you might as well keep it in cash. And so that's why the demand for money is greater here in terms of its nominal quantity of cash. And this is a buying bond mentality. They're increasing the money supply. The Fed, again, that vertical line. So anytime you're talking about money supply in the Fed, it's a vertical line in terms of increasing the money supply. And by doing this, they're lowering the interest rate. That B and I in BIRD is bonds and interest rates. And by buying bonds or open market purchases, buying securities, whatever you want to call it, that is essentially lowering the interest rate, which is going to be encouraging for people that want to buy a new home or add on to their house and get a home equity loan or a line of credit or something like that, because the rate is lower. And so they'll be like, hey, I don't want to put my money into other assets because the rate of return is much lower. So the opportunity cost of holding onto those assets is going to be smaller. So as a result, I'm going to demand more money so that I can buy those types of things that I just mentioned. So that's going to help the Fed in terms of putting money back into the economy and helping to grow the economy through buying bonds. So buy to grow, right? And then we see that with key graph 25. And again, you may want to pause it here before I explain it, just so you can copy the key graph down if you don't already have it in your graphing notebook. But the idea here in key graph 25 is expansionary monetary policy. The Fed is buying bonds. By buying those bonds, it's moving the money supply curve to the right or outward to MS2. There is a quantity of money that is also greater than it was at QM1. Now it's at QM2. And notice the interest rate has fallen. It's moved along the money demand curve at a lower equilibrium. E2 is now I2 for the nominal interest rate, meaning that there is a lower interest rate in the market that is being seen here. And so the allure of being able to get additional rates on other things than cash is not there. It's not as great. So more people are going to keep the money in cash, or they're going to put it into assets like I mentioned, and buying a new home or getting a car, getting a home equity loan or a line of credit. They're going to do that because the interest rate is lower. They're taking advantage of that demand for money, the interest rate being lower there. So buying bonds, helping to grow the economy by putting more money into those types of projects that then would be spent in the economy. And that's essentially what we see here. Now, if we look at the alternative, which is not what the Fed is doing right now, and going back to kind of where we are, key graph 25 is really indicative of what's happening right now. The Fed is buying bonds like crazy, and they've said we'll continue to buy, and we'll continue to buy corporate debt. We'll continue to buy and help the corporate infrastructure of the country as much as we can in terms of bringing consumer confidence back, because they know that that's so important to getting the economy moving again, especially during this pandemic. So that is what they would do, and this would be the result. Lower interest rates lead to people encouraging people to go out and buy homes, encouraging people to go out and spend money, and that will help to get the economy moving again. Now, the alternative of that, in better times, when you have concerns about inflation, you would see the Fed actually selling bonds. They'd be selling bonds on the open market, and that's decreasing the money supply. They're taking money out. By taking the money from the sales of those bonds, they're basically hiding them away, and that's taking money out of the marketplace. Notice the interest rate is moving up from E1 to E2. Driving the interest rate higher is going to lead to a smaller quantity of money that people are demanding because the rate is higher. Wow, it's not such a great deal anymore. Maybe I won't buy that house after all. And so people wait. People put projects on hold, and that essentially slows down the marketplace just by using the B and the I in the Bird monetary policy strategy. But the idea is, in the short run, this is driving up interest rates and slowing the growth of the economy by using this contractionary policy. All of this still open market operations, the idea of selling securities or bonds instead of buying them, because here we're selling to slow. Remember, buy to grow, sell to slow. So we're selling bonds in order to slow the economy. And that leads us to the next three graphs. This is the idea of contractionary policy, or selling bonds in order to slow the economy down. And I'll let you pause here so that you can copy this into your graphing notebook, and then we'll continue. So let me explain about key graph 26 for a second. Again, the idea here is that the money supply is a vertical line. This is the Fed that is basically selling bonds in order to shift the curve leftward or inward. The money supply is smaller, means the quantity of money is also smaller, and the money demand is actually moving along the curve to a higher interest rate. So we need less money. Higher interest rate means we're going to be able to put those assets into other types of things that can actually give us greater returns on investment. So we don't want to keep it in cash. We want to put it into other investments where we can get a greater return on our money. And so we will buy those certificates of deposit, those CDs. We'll buy those mutual funds and other assets that are going to help drive up those rates. So selling bonds is going to slow the economy down, encourage us to keep less money in cash, put it to more in investments, and discourage that spending as a result. So that's what we see here is a higher interest rate on that nominal interest rate. Inflation could be a part of that, but the idea is the same in terms of trying to slow the economy down. This is the contractionary monetary policy in the short run in terms of making that happen. Okay, so that leads us then to what happens when the money demand curve shifts, and that's kind of where we started this chapter, looking at this idea of the demand for money. Remember, the idea here is the real money demand changing, the change in technology and the change in institutions that are really driving this. Okay, so if you remember, the three things that we were talking about here was real aggregate spending, the idea of people spending more in the economy, which is driving money demand, and then you also had changes in technology, and changes in institutions. Those were the really three drivers that could shift this curve, either inward, leftward, or rightward, outward, which is what we see in Q graph 27. So here, if you have real aggregate spending, more people are spending money in the economy, as a result of that spending, people need more cash. So what are they doing with it? Well, the idea is the money demand curve is shifting outward or rightward to MD2, and that's driving up interest rates. That's driving the equilibrium now to E2 at a higher nominal interest rate. More money in the market in terms of people deciding to spend more in cash is going to lead to a greater demand, and that's going to lead to a higher interest rate as a result. Now, obviously, changes in technology could do the same. If there was greater technologies that people wanted to get their hands on, new iPhone came out or whatever, and new ways of doing things would lead to, hey, I need more cash because I need to go out and spend it on this new technology. That could also drive up rates and shift the money demand curve as a result. Now, the opposite is true as what we see in Q graph 28. This is the decreased demand, and I'll let you pause it here so you can copy down the graph in your graphing notebook, and then I'll explain it in a little more detail. So again, in those three things that move the money demand curve, the idea of real aggregate spending, changes in technology, or changes in institutions, you may have a situation in which people want to keep less money on hand. Maybe new technology is not coming out, and we're stuck, and families are looking at a recessionary type of period. They don't want as much money to be kept in cash because they're paying off their bills. They're not going out and spending. This leads to less money that we actually need. Or demand money for. So this is going to drive down those interest rates as a result of moving along the money supply curve. Money supply hasn't changed. The Fed's not doing anything here in this graph right now, but the money demand is changing in that the technology isn't there or the real aggregate spending isn't there. In a recessionary period, if households are spending less cash, that means the real aggregate spending is dropping. That can lead to a shift in the money demand curve. Likewise, new regulation new regulation in place that leads to families or businesses having to spend more money on particular regulatory requirements, or maybe they can't hire as much, or they can't buy new technologies as a result because they have to spend money in meeting regulatory requirements. That can drive money demand inward or leftward as well, and that would lead to a lower nominal interest rate, again moving along the supply curve. So that's really important in terms of the drivers here. All right, so shifting to this idea of those interest rates that we were looking at. Think of the federal funds rate as what you would, what the Fed is letting you, the bank, borrow money at. That is essentially a lower rate. The prime rate is what you would give to your best customer if you were going to loan them money. And then above that would be customers that didn't have as good of credit. And then you can see the 30-year mortgage usually is somewhere around, sometimes above it, sometimes below it, depending on where that prime rate is. But the Fed is going to adjust that federal funds rate and obviously the prime rate moves pretty parallel along with it based on what's happening in the economy. So if the Fed is lowering rates, then they're lowering the federal funds rate, they're lowering the prime rate, and that's going to encourage growth and investment. If they're raising it, that's trying to keep inflation at bay, trying to slow things down. Now, the scary part in terms of where you get into and where we are, what we've been talking about is this issue of the liquidity trap. If we lower rates too low and then there's nowhere to go, then what do we do if we come into recessionary times? And that was a lot of the concern, which is why you saw the Fed raising a lot of rates in the 2017, 2018, even into 2019. You saw them raising rates, and the president didn't agree with that, but it was policy to have somewhere to go in the event that there was a problem down the road that they had to try and address. If you lower rates to a point that you can't go any further, you get into what we had in Japan in the 90s, and they had to use a lot of fiscal stimulus, a lot of debt actually, in order to try and address that, in order to get out of that liquidity trap. So expansionary policy is going to increase aggregate demand, contractionary to reduce aggregate demand, and let's look for a second at what impact this has. If we're expanding monetary policy, we're buying bonds. If we're contracting, we're selling bonds. And let's see how the money is flowing as a result of this. So remember, buy to grow and sell to slow. But if the Fed is buying bonds, they're buying T-bills or securities, whatever you want to call it, essentially the idea is the T-bills are going from the banks back to the Fed because they're buying those T-bills. They're giving the money then to the banks, which is going to hopefully flow out into the economy through consumers and businesses that are going to invest in the marketplace. It's going to get the economy moving again. That's why we buy to grow. Selling to slow is what you would use in a very expansionary period in order to keep inflation at bay. And this is where the banks are actually buying those T-bills or bonds or securities from the Fed. The Fed is selling those T-bills, and they're giving those T-bills to the banks. Well, where's the money going? Well, the money's sitting at the Fed. They're hiding it. They're keeping it out of the marketplace because they're worried that too much cash out there chasing too few goods is going to lead to inflation and inflationary pressures, and that isn't what they want to happen. So if we look at the key graph then in terms of how this all shakes down, aggregate demand shifting to the right as a result of trying to use expansionary monetary policy or buying bonds, we're trying to close this recessionary gap. Trying to close this recessionary gap. So we've got an AD that's actually less than full employment, which will be LRAS at long run aggregate supply. By lowering those rates or buying bonds that lowers those rates, the aggregate demand is going to shift outward or rightward, leading us back to full employment and that equilibrium at E2, back to full employment. And this is what expansionary policy is meant to do. It's meant to fight that recessionary gap by closing that gap through increasing aggregate demand. Now, conversely, if you're trying to fight an inflationary gap, you've got aggregate demand that is obviously out here, and the concern is, well, if we sell bonds, we're taking money out of the marketplace. That's going to raise interest rates, which is going to basically put a damper on demand, and the aggregate demand is going to shift leftward or inward, and that's going to lead to a lower price level, but back at full employment, back at where we are, but we don't have to worry as much about inflation because aggregate demand is at E2. And as a result of that, price levels have kind of tempered, and we're back at long run. We're back at full employment as a result of that. So that's really important here in terms of driving home the importance of using contractionary policy, selling bonds to slow the economy down in order to fight that inflationary gap. Now, if we look at putting these two graphs together with what we're going to talk about later, which is the idea of loanable funds, you'll see here the liquidity preference model, the idea of buying bonds to slow the to grow the economy, leading to a lower interest rate. What's going to happen there? Well, as a result of the buying bonds, there's more money out in the marketplace. That lower interest rate also going to encourage an increase in the supply, well, ultimately the demand for those bonds, right? But there's also, because there's more money in the marketplace, that supply of loanable funds is greater, also leading to that lower interest rate as a result. And so what we see here is the nominal quantity of money, the demand for that money is at a lower interest rate, and the supply of loanable funds is also at that lower rate, increasing, moving to the right or outward as a result of that. And so that really shows how the Fed really tries to mirror the business cycle, really tries to make sure that what they are buying and selling in terms of buy to grow the economy, sell to slow the economy, they're doing along with what they see in the marketplace in terms of the cyclicality of the marketplace. So if you're in expansionary period, then they're probably going to be raising rates. And if they're in a recessionary period, they're probably going to be cutting rates. They're probably going to be buying bonds as opposed to selling them in order to try and mirror that. And you can see there is a bit of an output gap there, but the idea is they do try and listen to what the marketplace is saying, which is why they have those Fed meetings 8 times a year in terms of driving policy based on what's happening with business out in the real world. Out in the marketplace. So in the long run, what's going to happen? Short run, long run. We know monetary policy is what we call monetarily neutral, which I'll talk about in a second. But the idea that this is really short run policy trying to have an impact. And so what we see here is if we start out at long run, we're at E1, at AD1, aggregate demand it shifts to the right because of policies that lead to good times, expansionary period, we know wages are sticky, and those sticky wages will ultimately lead us to having to pay more to those workers, which is going to lead to a higher price level. So that aggregate demand, that inflationary gap, is inflationary because what do we see? If we end up back at full employment, we see higher price levels as a result of that, because of the fact that, hey, we may not have had to pay our workers more in the short run, but when we end up back at long run, we end up having to pay them more. So that monetary policy will help us in the short run in terms of driving that, but then is going to lead to a higher price level in the long run in terms of back at full employment. Now, that drives a couple of other factors, which we'll talk about at the end of this chapter, but essentially what we're trying to get to here is Keynes always said, in the long run, we're all dead, but in the long run, monetary policy essentially is ineffective because what it's supposed to do is to drive short-term policy in terms of helping to grow or slow the economy and help get us back to long run, get us back to a period of normalcy. And so if you look here at this example of what you've got here in terms of the liquidity preference model driving down the demand for money. As a result of that, the loanable funds is increasing. Well, we know that's going to encourage AD, which is going to lead to those sticky wages we saw in the last graph, which is going to lead to a higher price level. What's that going to do? Well, in that case, I'm going to need more money. If aggregate price level is rising, I'm going to need more money, and so the supply of loanable funds will then shift leftward or inward, leading to higher rates once again. So that is what leads us to the idea that we end up back at monetary neutrality, the idea that in the long run, it's not really going to have an effect. It's going to help in the short run, but then they're going to have to counteract it in the long run to keep inflation at bay. So in the long run, the idea is the monetary policy isn't going to do anything but be monetarily neutral in terms of the money supply in that respect. And what we see here is exactly what is happening there in the long run. The money supply, demand shocks can have that temporary effect in terms of increasing, but again, it's going to lead to a higher price level if something doesn't happen to bring demand back to long run at a similar price level. You can have that happen. AD shifts to the right and goes to 82, and then the Fed steps in to close that inflationary gap, pushing AD back down to E1, because if that doesn't happen, then what you end up with is SRAS shifting back, and you end up with higher price levels. So that's where if the Fed doesn't keep track of it and doesn't stay on top of it, you end up with more problems than you had in the beginning in terms of trying to close that inflationary gap. So the LRAS, very similar to money supply being vertical. Why? Because we end up beginning and ending back at full employment. The idea of real and potential GDP is equal in terms of what we see here. The long run begins at full employment at E1. AD shifts to the right. We end up out here. If the Fed were to sell bonds in order to slow the economy down, AD may shift back, but it's shifting back to LRAS. It's still shifting back to E1. So the idea is if they don't, then we're going to have to pay more in sticky wages, and then the price level is going to rise, as we talked about. But either way, we're going to end up back at full employment. So something's going to happen to drive us there. If it's not the Fed doing it and bringing AD back to full employment, then it's going to be sticky wages doing it. That's going to lead us back to LRAS or full employment, but we're going to have higher price levels in terms of making that happen. So that's why monetary policy is really meant to be a short-run fix, not a long-run fix. And what we see here is the same. The idea here is if you're changing the money supply, it's going to change aggregate price level. And if you're changing the money supply, which is shifting AD, if you don't do something to counteract that in the long run, you're going to lead to higher price levels, or you're going to shift AD back to its original equilibrium. What you want to watch out for in the long run is the idea that we talked about, the idea of liquidity trap. Congress and politicians, elected officials really like the idea of, cutting taxes and spending through debt. And both parties do it, both parties love it. But you have to be careful because what happens in good times is people don't want to cut back. People don't want to honor what Keynes was trying to do in saying, hey, you really need to cut back in those good times, because you need to be prepared for the tough times. And definitely spending, the $2 trillion bill in phase 3 that we saw of this economic stimulus that Congress passed, a couple weeks ago. The idea there is that if you don't cut back on that somewhere in good times, you're not going to have the money to be able to pay for that in the bad times, and you can't just keep spending like that. But it's really hard for an elected official to say, hey, I want to raise your taxes and cut spending. That's not a very popular position to get reelected. And so that's why we see with the Fed essentially doing the same thing as, the president's been tweeting, the Fed's doing the wrong thing, really trying to get them to lower rates. Well, you got to be careful because of this liquidity trap. You don't want to get into that habit where there's nowhere that they can go, because if you can't lower rates any further, then you really are reliant on fiscal policy, Congress and the president, to spend, and that's exactly the problem Japan had, and it took them many years to get out of that, and they're probably still paying for it as a result. Okay, so in the long run, interest rates. The idea here is we can see an increase in the money supply is going to lead to a fall in the interest rates, because as money supply shifts, the idea is the money demand is falling, leading to a lower interest rate, right? A decrease in the money supply is going to lead to the opposite, where interest rates are rising because rates are moving along that money demand curve to a higher interest rate as a result. But in the end, what happens? There's no effect, because what is going to happen is even if they're nominal, it's inflation that's driving that. The interest rate isn't going to change, because either SRAS or AD is going to shift us back to long run, and we're going to end up at the same place where we started. So this is the one that probably gave the students the most trouble in terms of taking a look at, but I think really tells the bigger story of how we get from short run back to long run, from long run to short run and back to long run, is we look at key graph 25 here. Number one, I'll refer to the numbers here because it'll make more sense, but this is the key graph we started with, right? The liquidity preference model. The money demand curve is moving because of the money supply buying bonds. The Fed is buying bonds, moving money demand along the curve to a lower interest rate. That's going to encourage investment. That real liquidity preference model we talked about is driving down that interest rate, so the real quantity of money is actually increasing. More people want it. Increase in the supply of loanable funds. We've got more money out there in terms of that quantity of loanable funds, and at a lower rate. Everybody wins, right? So that leads AD then from 3 down to 4. We have AD shifting outward or rightward. And we know that one of two things is going to happen. Either the Fed is going to have to sell bonds and use contractionary policy to slow that down and bring AD back in order to keep those inflationary pressures at bay, or sticky wages aren't going to be sticky anymore, and you're going to have to pay more for those workers, and you're going to end up at a higher price level. But the aggregate price level, again, is aggregate, and so the idea there is that could lead to inflationary pressures. The Fed, using contractionary policy to drive up those interest rates, would shift aggregate demand, and that would lead us back to E1, so there wouldn't be a whole lot of price level pressure there in those terms. But it really does drive the point that in the long run, the changes in the money supply don't affect the interest rate, the real interest rate in that aspect, because of what we see here. Okay, there is another activity for you to do along the way, which is activity 4-4. I think you got that as a handout, but it's also on Google Classroom. I also will post the answers to that so you can check your work, and then bring to class, our virtual class, any questions that you have on that I think you'll find helpful. One other graph that I want to take a look at here is this idea of money and inflation. Krugman talks about this a little bit in terms of this relationship, long run, to money supply and changes in aggregate price level. Obviously, the more we increase the money supply and the more we grow that money supply, inflation is going to be more of a problem. But this is assuming that you also don't use your contractionary monetary policy to dial that back. The idea is the Fed really should be using expansionary and contractionary policy. They shouldn't just be buying bonds in bad times. They should be selling bonds in good times in order to bring up those interest rates and to keep the money supply in check. That's what's going to keep inflation at bay. And we've done a pretty good job of that, as you can see here. Other countries, not so much. Again, because in a lot of cases, elected officials really don't want to raise interest rates, and they know that raising interest rates always leads to concerns about unemployment, the Phillips curve, the idea of unemployment being a trade-off between inflation. So if you're raising inflation, then or you're cutting inflation, then you're raising unemployment, and you don't want to do that. But there is a happy medium, is the point that Krugman's trying to make here. There's a happy medium between the two, and getting to that point is really the driver that's going to keep us in this under 10 in the growth rate and under 10 in the inflation rate. So there is balance. The whole point of a happy medium is a very important one here. Another activity is, and the one to, I believe, close out this chapter is 4-7. 4-7 closes out this unit, looking at monetary policy, and then there is also the sample questions that will take you to the end of this chapter. So I hope you found this helpful. Again, bring questions with you to class, and post them on Edmodo, or email me if you have other questions on this chapter. And hopefully you found this helpful. Again, doing those activities that I mentioned, if you don't have a copy of them, I will make sure that copies of those are available on Google Classroom, as well as the answer keys so you can check your work. Unfortunately, we won't have time in 40 minutes to be able to go through that in order to go through each one line by line, but I will post the answers on Classroom so you can do that, and then bring any questions that you have with you to class this week, and you'll definitely find that helpful. All right? Again, email me or post them to Edmodo if you have any questions, anything I can help with along those lines on the content. And again, go back through this chapter if you find it helpful. Otherwise, we will see you in chapter 32, looking at unemployment and inflation.